Okay, a couple screens of housekeeping before we head in. Applied Energy Analyst. We do now have an external exam proctor selected. IT is just working to integrate the interface with our system. It's going to be a write anytime exam. When you're ready for it, you sit and write. We expect that bookings can start from May 1st onwards. We do have 3 exams. I've explained this one before, $75 per exam, and you only write when you're ready. It's not like you have to pay the exam fee and then do or die. When you feel that you've got it, you say, okay, let's do it. It should take you anywhere from 3 to 6 months to complete the whole program. It is part of Applied Analysis, so if you have a subscription to Applied Analysis, all the content is in there for free. You just pay for the exams if you want something to signal to the marketplace that that you know this stuff. I am beginning the Applied Metals and Mining Analyst program as well. Derivatives trading for U.S. metals, that is done. Same with understanding rare earth minerals. I've got to update that and upgrade it a bit more, but it's mostly done. I'm almost done the introductory reading for all of it, which is Mining Geology for Analysts. If you don't understand the geology, at least have some basic understanding of the geology. It's going to be hard to read mining reports. About 2 more weeks, that one will be up. And this will be in the materials sector. They'll just show up, so you can actually start reading them anytime. Some of the other readings that are in behind this, mining methods, one reading dedicated to junior miners, one to senior miners, one for mining for metals, each of the metals. What's different about gold mining versus copper mining versus zinc versus uranium versus platinum, palladium, things like that. Reading on mining drillers. I've done most of this one. I've got to just bring it up to a quality sufficient for what I'm doing here. Smelters. So this I anticipate, I'd say late summer. this should be ready to launch. And since we've already got our external exam proctor, we don't have to go through that process again, nor the integration process. It'll be ready to go. Costa Rica seminars. I do have some spots available. March 14th to March 21st and March 29th to April 4th. There are 3 spots in each of those 2 weeks. And then going out to April 12th to 18th, April 19th to the 25th, I've got 2 spots in each of those 2 weeks. And during the week, we focus on active strategies, focusing on volatility, momentum, timing alpha. If you were here this past week, for the ones that were here this past week, we had significant timing alpha because we buy on red days, right? Okay, for all the applied level subscribers that are listening, of all the applied level subscribers we have about 28% that are on Discord. The other 72%, we don't know where they are. And I'm not about to do a big email campaign, so this is where I'm going to reach you. You're missing a lot if you're not on Discord. If you do have access to it, you're missing all the lives that I do based on New York time, Sunday night 6:30. A pre-week analysis when Globex opens. Monday to Friday at 8:15, pre-market risk assessment and what the daily plan is. I do post my trades during the day, and then Friday I will be posting my positions, and it'll just be a few documents that I upload, which will show the delta, the gamma, the vega, and theta of all my positions. What you see on the screen is just an example of what you're missing and what I do. This is February 12th. This is February 11th. These were days where the market was not being very friendly. So we go shopping. You can see here for Cloudflare, sold 10 $200 puts for March expiration for $20.25. Robinhood, sold calls. Reddit, sold calls. Astera Labs, sold puts. I post all of my trades so that you can see exactly where I'm posting them. This was a earnings play, and this was an earnings play. The ones near the end of the day tend to be earnings play. And all I'm looking here is volatility crush. So you open them at like as close to 4 o'clock as possible, and then the next day you close them right after 9:30, as soon as possible. These made all of their earnings, and I think I did 2 more. I just can't remember which ones I did. I think I did this one here. No, not this one. I forget. I think I did Datadog and another one for the week. But if you're an applied level subscriber, you are missing a lot. This is included. Simply go to the applied level and click on any module. Click on sector studies, and on the right of the screen you'll see join us on Discord. Click on that and you're in. We'll start again this week with economic data. We had both sides of the Fed mandate. We had the jobs report on one side, mandate 1, full employment, and we had CPI on the other side, mandate 2, price stability. I know CPI is not their favorite measure. It's PCE, but CPI is worth taking a look at. Let's start with the jobs report. And I'll tell you, ZQ did not like this. Pulled back 8.5 points almost right away. And not to be outdone, the bird decides that it's going to join in on my video. This is the risk of doing this outside. But I do have a nice view from my office. Let's have a look at our jobs report. Non-farm payrolls, 130,000. Government payrolls were down 42. That means the private side produced 172,000 jobs. Wow! And almost everything about this report was good. Too good. Not that I'm saying something is going on, but it just every single measure was a yay. Unemployment rate, 4.4 to 4.3. Yay! Average hourly earnings, yay, for the workers, 0.4%. Actually came out to 0.402. Participation rate, 62.4 to 62.5. More people getting excited and working longer, 34.2 hours to 34.3. So the combination of higher hourly earnings and more work in the week means the average weekly income exceeds 0.4%. Government payrolls, 42. Well, 42,000 people. That's a disappointment. But for the taxpayer, that's 42,000 people less you have to pay for. Manufacturing, first in 9 months. Last 8 months, negative. First positive print. Non-farm payrolls, 172. Even U6 came down to 8%. Let's dive into the details here. Household said plus 528. But we don't add up here. Less than high school gained 5. High school gained 262. Less than BA lost 230. And more than BA gained 32. Does not add up to the 528. Looking at the establishment survey, 130,000. Goods sector produced 36. Services sector produced 136, but healthcare and social services 123.5 of that. See the effect of AI somewhere. Financial services, negative 22,000. IT, negative 12,000. These two sectors lost 34. And of course we had revisions. November was revised down by 15,000. December revised down by 2,000. And all of 2025, the reported 584, all of the revisions brought that down to 181. And over 2024 and 2025, the revisions brought that down by 1 million. So if we look at this number, 181, that's about 15,000 a month, which is far less than what healthcare provided on its own. I've got some interesting charts from the Wall Street Journal. The very next day, it published 2 stories about the jobs market and showed that under the surface, if you get rid of healthcare, because healthcare jobs would happen whether you're in expansion, flat GDP, or in a recession, an aging population would explain those jobs anyways. That's not the economy, that's demographics. Yes, I hear some of you saying, but it's still a job. It's still somebody walking home with a paycheck. It still adds to aggregate demand. Yes, it does. It's just not the productive economy. It's the maintenance economy. that is adding those jobs. If you did not have the demographics that the U.S. has, you wouldn't have those jobs. Initial claims we got the next day, 227, still a little bit elevated. Last week was 232. Expectation was for 222, sorry. Came in a little above expectations. The 4-week average climbing upwards again, 219,000. ADP said during the week 6,500. My pen is not writing on this. There we go, 6,500. That is a run rate of around 26,000 a month. ADP had reported 22,000. It's sort of in line with where their model is. Retail sales, zero. And the ECI came in lighter. Employment cost index, this is for Q4, from 0.8 down to 0.7. And we will get our first look. We'll see the calendar shortly. Our first look at Q4 GDP next week. Okay, we've got a number of charts on the screen. I tried to get them all on one screen. We have 6 charts. Some are from January of 2025. Some are from January of 2024. This is change. This first one in the top corner is change in non-farm payroll since January 2025. So this is 13 months because it does include January of 2026. So this is the total amount right there. This is health and private education. If you take off health and private education, look at everything else, look at this. The underlying economy, the productive economy is been shedding jobs for the last 13 months. Let's look at it for 25 months. This is change in non-farm payroll since January of 2024. Again, here is your total. Here is healthcare. And if you take that out, look at that. Over the 2-year period, you basically created no jobs. It looks like through 2024, you were going somewhere, and then you gave it back in 2025, which we're seeing over here. Down here, losers and winners, change in payrolls. 2024 and 2025, the white circle is what was originally announced, and the dark circle is what it was revised down to. So you can see how in every sector you're almost revised downwards, except for one. Private education was revised up. There is healthcare over here. You can see your productive economy sort of in here, and there's healthcare. Again, the changing demographics in the U.S. would explain this. You have a population that is that looks like this in the U.S. Your age cohort 0 to 5, 5 to 10, 10 to 15. You have the plus 60. It is a much larger cohort than the cohort that is entering the labor force in the U.S. Based on the baby boomer population. Based on when they were born, they would hit 65 in 2010, and that 20-year cohort would be retiring all the way to 2030. 10,000 people a day in the U.S. Retiring, 10,000. So that change alone would explain what's going on over here. Empty cubicles, change in non-farm payroll since January 2024. You have financial activities. Look at this, almost no jobs in financial activities. IT has been shedding jobs. Professional and business services has been shedding jobs. This is blue-collar workers over here. Change in manufacturing payroll since January 2024. And here I put Liberation Day. So you can see the drop into Liberation Day, and then after Liberation Day, more people were liberated from their jobs, and because of the tariffs, many Americans were liberated from more tax dollars. Liberation Day, don't you just love it? Data centers everywhere. This is for 25 months. Changing construction payroll since January 2024. Here is residential, losing jobs. This is heavy construction and civil engineering. Not really great growth, but growth nonetheless. This is non-residential. That is where your data center activity would be happening. The very next day after non-farm payroll, ZQ almost came all the way back and almost reclaimed everything it lost, and was strong into the end of the day ahead of CPI. Even the next morning going into 8:30, ZQ was pushing green, almost unconcerned about what the CPI would be. And I wonder if overnight after the headline number, 130, yay, and after that faded away, and you said, oh, it's all healthcare. If you control for healthcare, if you look at the revisions, the economy, at least the job market the productive economy has been in recession for the last year. Maybe that's what we saw on Thursday in ZQ, that, oh, hang on a second now. Or could it be, dare I say it, that the market is saying, if you listen to everything Warsh has ever said, he does intend to cut short rates. He intends to keep inflation in check by running off the balance sheet to keep the long end of the curve high, because that's the price of all consumer credit. Do you think maybe collectively they were saying, we're being a little stupid here? I don't know. But anyways, I thank Thursday for giving me back what I lost on Wednesday in ZQ. And oh boy, did I love CPI. Friday, we got our CPI, not the Fed's preferred gauge. They prefer PCE because it does have a modicum of substitution in there, and it does have fewer imputed prices as a percentage of the measurement. Core inflation, month over month. Let's look at our numbers. Core 0.3 came in as expected, 0.3. I've got some extra decimal places for you down here. Year over year. Inflation headline, month over month, 0.2. Expectation was for 0.3. Yay. Year over year, core came in at 2.5 as expected. Headline came in at 2.4, a little bit lower. Let's look at our extra decimal places. Let's look at headline. It was 0.17 month over month. And our month over month here is 0.2. So 0.17 rounded up to 0.2. I say this every time almost. There's so much information in the second decimal place. I can't imagine it's that expensive to add the second decimal place to this. Almost every other country has multiple decimal places, but let's round up, right? Year over year, 2.39. There's your 2.4. You got to give it to that one. Core 2.95 versus 0.3. Year over year, 2.5. So all of these check out. Let's look at Supercore, 0.355 month over month. Year over year, 2.09. Anything we can do with this? Let's look at Zillow, observed rent index, month over month, 0.09. And year over year, 1.95. If we look at home value index, month over month, negative 0.35. Year over year, 0.2. And CPI overweights the cost of this. We can see that housing does have some impact, because if we go from core to super core, it actually increases, which means the extra weighting on housing actually increased the view. So PCE does typically come in under CPI, but I wouldn't expect it to come in way under CPI this time. But still, we are making progress towards our goal. And if you remember the last screen, the productive economy is just not producing. Now, here's another experiment you can try in your head. Take all of these deficits from 2020, 2021, 22, 23, all the way to this year of 6%, 7% of GDP, and go back and control for GDP growth by removing the budget deficits. That if the government ran a balanced budget, considering the jobs market, the U.S. economy has been in or near or at a recession now for the last 6 years. So, basis point cuts, I think, are well in order, although I don't think that the Powell Fed will see it this way. They look at what's right in front of their face, and I guarantee you, in the next press conference, they'll say, we're seeing that the jobs market is recovering. We had 130,000 jobs in January, and we'll ignore the fact that that was purely demographics. It would have happened anyways. It's not a sign of strength in the job market. It's a sign of the age of the population. I don't know if they have the intellectual horsepower to separate those two. I just don't know. I know they're capable of it. I just don't know with the groupthink and the path dependency that they've developed, that they're able to jostle themselves out of that little rut that they're in. So probably really good timing that we have a new Fed chair coming in. Let's look at our economic calendar for next week. Monday is a holiday, so your market withdrawal is going to have to last an extra 24 hours. I will still do the Sunday night 6:30 Globex live on Discord. I don't know what information we'll find on there, but we'll have a look at it anyways. One thing I forgot to mention on the previous screen is the administration's move over the last little while to lower and remove tariffs. Last week, aluminum, steel. You think they're getting religion? You think they're looking around saying, "Look, are we the baddies? Are we the bad guys? Do you think we're doing all this? Maybe we should reverse it and declare victory. The tariffs did what they were supposed to do. Trillions of dollars poured into our country. We don't need them anymore." They got to declare victory somehow. Let's look at what we got this week. Bowman speaking on Monday. Not much else going on. Tuesday, ADP employment change. Get that at 8:15. And then big day for Canada. Canadian duration and inflation measure. The housing market index, National Association of Home Builders, it's been under 50 for quite some time. Bouncing 35, 36, 37, up to 40, bouncing in around that area. Barr and Daly speaking that day. I don't think Fed speak really matters anymore. We're seeing the last days of the Powell administration. The only Fed speak that is going to matter is Warsh's acceptance and whatever opening statement he's going to make expressing his vision for what the Fed is going to be. I think that's the only one that really matters. Get some more housing data on Wednesday, building permits, housing starts. We also get durable goods in there as well. In the afternoon, FOMC minutes. Going into Thursday, exports and imports, both for Canada and the U.S. We get the trade balance. This is for December. We have Bowman speaking. I think that's really about it that day. These are all minor reports coming out. And then Friday, big day. You have retail sales and PPI in Canada at 8:30. In the U.S., you have core PCE for December and our advanced look at GDP. Our first look at fourth quarter GDP. Remember, it has the shutdown in there as well. Probably there'll be estimates of how much higher it would have been had there been no shutdown. And PCE, this is the Fed's preferred gauge. What are we looking at? 0.2. Previous consensus, 0.4. That is far more aggressive than CPI. Where's our, this is for the core. Where's our headline? PCE price index core. It's in here somewhere. I don't know what the estimate is. 2.8 price index year over year, 2.8. Coming in higher than CPI. The expectation, 2.9. This might be another beautiful day for ZQ based on what CPI said, or an ugly day. New home sales, Saturday at 10. So we'll have new home construction or new housing starts and new home sales for the week. Okay, let's look at rates and yields. Big story in yields last week. TLT had a beautiful week. Look at that, up 2.47%. Positive for the year. Almost 3%. Add that to the 4% yield you'll get by holding it. If we do nothing more, you've got over a 7% return on TLT. We've made some new cycle lows. The 1 year, 3.4 on February 10th, and the 2 year, 3.4 on February 13th. Cycle lows. Look at that. Week over week, the whole long end of the curve came down, and if we look at year to date, we have flatter curves, we have lower yields. That is called a bull flattener, and that happened all within the last week. We've had a bear steepener up to last week, and then boom, down we go. I don't understand why it hurt KRE, but there we go. Still up 10% year to date with a nice yield. Dollar index still just sliding. XLU had one hell of a week. Look at that, 7.27%, up 8, almost 9% for the year with a nice dividend yield. IYR had a good week as well. Contrast that with REITs over in Canada, which had a bad week. Man, did they have a bad week. But the U.S., other way. XLP, printing out another gain. Staples and utilities and gold on fire. Market choppy. Jobs reports under the surface not too great. Inflation coming down. This doesn't look good, especially when you have this asset flow into defensives like this. And look at your equities all last week. SPY down, IWM down, triple Q's down, and SPY is flat for the year. All the gains are gone. Triple Q's showing a loss. Only IWM still sitting with a gain for the year, 6.82%. The story last week, yields and ZQ. ZQ now pricing in 64 basis points for the year. Big jump up from last week. That's 2.5 cuts in 7 as opposed to 2 cuts in 7. But going out to May of 2027, we're still sitting at 2.5 in 10. I still think you get one more under Powell. And I think you get one under Warsh. Then I think the July contract should be pricing in 50 basis points, and it's barely pricing in 25. I think it's like 2 or 3 basis points below actually declaring 25, and I think it's a no-brainer that you're going to get one under Warsh his first time out. He's going to have to deliver something, and if Powell delivers nothing, you might see 50 from the guy, but at least 25 in July, which is the month after the June meeting. It's a clean month with no meetings, and ZQ, the R in the ZQ is the average of the rate over the month. It's a clean month, should be the same rate every day. Isn't even pricing in one full cut. Look at the change that we've had week over week. October, week over week, added 2 basis points. December added 5. April added 13. May 12.5. Call it 13, depending on where it closes and where the last transaction happened. But I think the market, even with that strong jobs report, when I saw the strong jobs report and I saw ZQ move, I thought, here we go. We're going to have to actually wait till June for ZQ to perform. And the next day, boom. Sometimes I can't figure this market out. You know, we had REIT earnings in Canada. Killam had what I thought were good earnings, and it dumped, like 5% dump. And then CapREIT reported the next night, and I looked at its report, and I thought, Killam had better numbers, I think, and CapREIT went up. And I thought I was an expert in REITs. Maybe I don't know what the hell I'm doing after all. Okay, look at real yields. All of them negative. This is the two things we've seen so far. The dollar index lower year to date. The real yields much lower year to date. The 10-year down 16 basis points. All supportive of precious metal prices. Look at gold up 1.63 for the week, given the direction of real yields and the dollar last week. If you just gave me those two things and said make a bet on gold, the higher probability would be on it went up, and it did. Big performer, 16.44% for the year. We're almost at cycle lows on the 5-year, 1.19. About to take out the September 8th low on that one, 1.16. Break evens, look at this, all down week over week, all of them down. Still a little elevated. Look at the 5-year, up 16 since the beginning of the year. Let's see if next week helps us or hurts us. Let's have a look at our metals. Silver, not so much of a good week. The industrials, copper and aluminum, if you're going to remove. This is the aluminum price I use in this is an LME price, not a New York price. It's an LME price. So it doesn't really reflect the change in New York. New York had a bigger drop in price, but I feel that since it's clouded by the tariffs, we're not getting a true spot price, a true measure of the industrial value of aluminum. So I use LME pricing. Platinum down, palladium up. copper sold off. I took this opportunity to sell more puts. I now have 7 puts on March 26th copper. March 26th copper with, I think it's the April or May underlying for the futures contract. But I have 7 of them now. I'd like to get to a position of being long 10 copper contracts, which would be 250,000 pounds of copper. Woohoo! I do think eventually the 6s will become common, and 7 and 8, I think, on copper is simply just inevitable. So I want a levered bet on that. Anytime I see copper push down to low 570s, printing 560, I'll add to that position till I get to 10. I really can't see a 4 handle on copper, not unless you have some global recession, some credit event that brings down the world like it did in 2008. And even then, it wouldn't hold there for very long. If I saw a 4 handle, I'd probably want to go to 20 contracts, even 30 contracts. It is, I think, a no-brainer bet all the way to 2030, even 2040. I think copper's a no-brainer bet. I've broken this down. We have energy here and food, and with the food exposure, I also added live hogs and live cattle, so that we have the grains and we have the meat. This is food and energy. This will add to headline inflation, but not core inflation, and it's not coming along for the ride. We see year-to-date oil up 9%, even though it pulled back for the week. Natural gas had another bad week here, down 13% since the beginning of the year. And as we move further out of the winter, going more into February, end of February, beginning of March, you start to roll up in the U.S. into spring until you get to end of March, beginning of April. It's pretty much over for the big heating season. Look at your grains. Wheat, year-to-date, 8% up, 3.5% this week. Soy added 1.8%, up 10%. This is just year-to-date. The only relief you're getting is from corn, down 2%. If we move into the meats, live hogs up 2%, so your pork is more expensive. This is meat on the hog. So by the time you strip it down, it's actually less. It's actually more expensive because this is what you're paying, or this is the change in price on the hog itself. And live cattle up 5.5%. So if you look at pork, beef, soy, wheat, all up since the beginning of the year. And the only one that's in line with inflation is pork, 1.9. All the others are way above the headline rate of inflation. Cargill shut down another processing plant. I shouldn't say another. Another processing plant was shut down, this time from Cargill, citing a lack of cows, a lack of cattle. There just isn't enough being sent to slaughter, and they shut down another facility. There is a herd problem. But as soon as you mention, the administration mentioned a while back, we're going to allow more imports in from another country, the whole beef industry, it's not going to solve the problem. Well, the problem is if you have high prices, it encourages your herd to grow. Their case is if you lower the price by bringing in imports, cattle farmers don't have the motivation to add to their herds as much as they do, and then you end up relying on imports for a very long period of time. I don't know. I seem to think that you could have imports raise your import quota for the next 12 months and then revert back so that you still leave the motivation for feeder cattle, because it takes a while to go from a feeder cattle to a live cattle, and then live cattle are where you fatten them up to then send to the slaughter. But I don't know where that went. Anyways, there you go. Beef prices are wickedly high. March 18th, FOMC, and we get the summary of economic projections. I wonder if it will include something in there, if the participants will say, well, based on, because Warsh must be having conversations with some of these people by now. You don't just show up on day one and introduce yourself. There's always a transition period. There's always probably, maybe he's not until he's confirmed. I wonder if he'd still reach out and say, hey, why don't we have lunch or dinner? I don't think they can discuss anything with him. Maybe that's the case until he's confirmed. But once he's confirmed, he'll start having conversations with them. I just wonder if in the summary of economic projections, if it matters, if it'll just be, oh, this is a Powell-fed projection, or will it be a Warsh-fed projection? 90% that nothing is going to happen. 9.8% of a 25 basis point cut. I would have put more probability on that. 90% that nothing's going to happen. And in fact, for Powell's last stand, he's only got 2 more this March, and I believe it's the April one. For his last stand, 98% probability of 1 or no cuts, up from 94.7, and the probability heavily went to the 0. Shifted down from the 25 to the 0, that Powell's not gonna do a damn thing. My projection, or at least my feel of this, is we'll get 1 from Powell, and then he will leave his seat. He's not going to stay on as governor. He will leave his seat, and we'll get 1 more, just to say that he got pretty much at neutral, or whatever the belief of neutral is. His legacy is probably intact at that point. Got us through the pandemic and a soft landing after that brutal event with the highest inflation in a generation, and brought it down at his exit, maybe low between 2 and 2.5, with ending right at the neutral rate. Talk about returning the car full of gas and putting it right in the parking spot where you left it, right? I think that's what's going to happen. Warsh's first stand, at least 1 cut. Almost 70%, down from 75. So, I thought earlier, when you look at GQ, could the market possibly be feeling that Warsh is serious about it? When I look at this, the probabilities went down 5.5%. I don't know. I gotta stick with my statement I've been saying for the last 5 or 6 years. Prices these days reflect the stupidity of the crowd, not the wisdom of the crowd. Reverse repo, 377 million, 0.377 billion. That is the lowest we've seen this cycle. We're approaching that 0 line. Once you hit the 0 line on that, these things start coming down very quickly. Reserves under 3 trillion, 2.958. The Treasury General Account, 910 billion. And SOFR, we're going to start watching SOFR, because if there is stress, we're not going to see it in effective federal funds rate as fast as we see it in SOFR. 3.65, effective federal funds rate is 3.64. SOFR is a lot more volatile. If you look at effective federal funds rate for the last 30 days, 3.64. 3.64. If you look at SOFR, it's been 3.61, 3.63, 3.65, 3.69, 3.67. It does bounce around, so if there's stress, we're going to see it in SOFR, so we're going to start monitoring that. Mortgage rate, 6.09, just won't print a 5 handle. But this is as of Thursday, so I went to Mortgage News Daily to get the Friday rate. It's measured almost the same way, 6.04. Still not printing a 5 handle. I think once you start printing a 5 and under 5, National Association of Home Builders might start to print a, dare I say it, 45, 46, maybe a 50. Maybe a 50. Mortgage apps down 0.3 for the week ending February 6th, and this was just bad. Existing home sales for January down 8.4% month over month. That is not year over year. That is month over month. It is the biggest monthly decline on a percentage basis for like 4 years. Month over month down 8.4. These are seasonally adjusted. You could say, yeah, but January's a slow month in real estate anyways. These are all seasonally adjusted. So given that January is lower, this is saying seasonally we would expect it to see this much lower month over month. It's another 8.4% lower than the month before. Now, you wouldn't know that by looking at the sector. D.R. Horton last week printing a 52-week high. And Nail, which is a triple levered ETF, I play with that one because I like the volatility of it. I use puts on that one, in the money puts, and I just keep rolling them and picking up that volatility. 56, it was low as 56 a few weeks ago, over $70. You wouldn't know it if I told you where mortgage rates were, where mortgage applications were, where the home builder sentiment index was, and where existing home sales were. You'd be saying, it doesn't seem to make a lot of sense that they'd be up. You'd think, well, maybe is now the time to buy? Instead, I think the right question is, now the time to sell? Okay, let's use AI again this week. There has been a chart making its way around this past week. It's about 8 months old. It's from a Goldman Sachs research report. AI agents to boost productivity and size of software market. And it is this chart down here, the profit pool in software expected to shift towards AI agents. Not suggesting that it's shrinking. 2026, here we are, sitting around 30 billion, projecting a total addressable market of over 50, looks like 52, 53 billion by 2030. With SaaS down at 20 billion, it's making up about 30 billion of the market right now, and you can see the size of the agent AI market. Now, this does not imply that SaaS companies are dead, only that the ones that survive will shift towards this, and also their pricing will shift towards this. So the story that has been floating around about seat compression is, look, you can have an AI agent that can do the work of 10 people. So a company is going to build an agent to interface with the SaaS software using MCP, which is Model Context Protocol, which was introduced by Anthropic late 24, which is a way for AI agents to talk to different applications. And then all the company will do is have 10 different interfaces so that the employees can interface with the AI agent on their own, and the AI agent can interface with the SaaS application in the background. There you go, one seat license. And the story is, SaaS companies are going to catch on to that. We are already seeing a shift from seat-based licensing, seat-based revenue, to usage-based. Okay, Mr. Company, you're going to make your AI agent do the work of 10 people. We're going to switch to usage-based pricing, and look at this. Your agent is using it 10 times more than anybody else. So your fee is 10 times more than it would be if only one person were using it. This way here, it doesn't affect their revenue. And then there is a third variant of the pricing, which hasn't been talked about, which I've given this question. I'll show you the prompt. I've given it to 4.6, Claude 4.6, extended thinking. I said, answer these questions for me. Let's have a look at that. Okay, I'm using Opus 4.6 extended with Claude, and here is my prompt. I gave it just a quick synopsis of the research. The prediction AI agents will capture over 60% of the software pool by 2030. I gave it the key projections. And then I ask it, what companies in the SaaS space are best positioned to benefit the most from AI agents? Take some time to familiarize yourself with the research. Discuss the shift to AI agents. Discuss the concept of seat compression. Discuss trends from subscription-based pricing to usage-based pricing. Discuss the likelihood of current customers redirecting their IT teams to move SaaS on premises. Discuss what companies will benefit from the move to AI agents over the next 5 years if we accept the prediction of the Goldman Sachs research. And when it tells us what companies will benefit, it gives most likely to benefit. Companies that may benefit, but they face execution risk. Companies least likely to benefit, and a fourth category, which I didn't ask for, is niche winners. Wait till you see what's in there, and hey, no jumping ahead. We all have to go through this linearly. Shift AI agents, what Goldman is saying, core thesis. is AI agents representing the next milestone, generative AI, moving beyond pattern matching chatbots to autonomous systems that can reason, remember context, and execute multi-step workflows through APIs with minimal human intervention. Projected to be 60% of the software pool. This is not a zero-sum story. The pool shifts to agents, but the entire market for software gets larger, from 30 billion to over 52. We don't need to read the rest of this. Let's look at seat compression. Traditional SaaS model is elegant in its simplicity. You charge per user per month. Revenue scales linearly with the customer's headcount. AI agents break that correlation entirely. If 10 agents can do the work of 100 people, the headcount that justified those 100 seats evaporates. And so does the revenue attached to them. Agents do more work per human, which means fewer seats needed and slower seat expansion. So you can imagine this little circle I'm drawing with the mouse is the application. Over here is the AI agent, and the AI agent communicates with the software application through something through a format called MCP. And from this AI agent, you have 10 interfaces over here that interface just with the agent, and one line that interfaces with the software. The market has already been pricing this in. As of late 2025, median enterprise value to revenue multiple for public SaaS companies stood at roughly 5.1, down from the pandemic peak of 18 to 19. Let's get down to the pricing transition. Usage-based pricing. Align with cost consumption, but introduces unpredictability that CFOs hate. And this is the issue. This is when we look at Datadog, this is an issue that Datadog experiences. Is they have usage-based pricing on some things, and customers get the bill, and it's like, whoa, how is this possible? Because it's unpredictable. Vendors have discovered that scaling from pilot to production routinely reveals 500 to 1,000% cost underestimation, which creates sticker shock and budget chaos. Outcome-based pricing pay for results. Tickets resolved, meetings booked, revenue generated. Extremely hard to implement. How do you attribute an outcome to a specific piece of software? Agentic Enterprise License Agreement. If you see the acronym AELA, that is Agentic Enterprise License Agreement. You want an AI agent? Let's have a specific license agreement for that agent. What's actually gaining traction in practice? Salesforce's Milano described their AELA model as a flat fee, all-you-can-eat approach for customers ready to scale, essentially shared risk between vendor and customer. Salesforce initially tried $2 per conversation for Agentforce, but moved to flex credits at 10 cents per action when that proved problematic at volume. Cloud repatriation and moving SaaS on premises. So this says, yeah, there is some of that going on, some stuff going on, but it says here the realistic outcome is hybrid. Predictable, resource-heavy workloads, ERP, steady-state, AI inference, regulated data move on-prem or to private cloud, while bursty, experimental, and scaling workloads stay on the public cloud. Most SaaS applications that companies subscribe to, Salesforce, ServiceNow, HubSpot, Workday, are not the kind of thing IT teams are going to rebuild internally. I made that argument last week, that companies are focused on executing their mission, not on telling their IT team, okay, let's refocus now and let's program a whole bunch of stuff that really doesn't target what we're doing, but just adds the administrative overlay. They're not going to redirect their IT teams to do that. Most companies already run lean to begin with. That they would have to either lose their focus on what the IT team is actually doing or increase their IT budget. Let's look at who benefits over the next 5 years. Tier 1, best positioned incumbents. Microsoft stands apart. It's the only hyperscaler that can fund massive AI capex from operating cash flow. It controls the productivity stack where most knowledge work actually happens. Copilot Studio already allows consumption-based agent building. I have not heard anything good about Copilot. I have not heard anything good about it. So GPT-5 integration gives it a model layer advantage. Microsoft's risk is execution complexity. ServiceNow, arguably the purest agentic play. I am long Microsoft. Well, I should say long. I have positive delta exposure to Microsoft, positive delta exposure to ServiceNow. Purest agentic play among incumbents. Q4 revenue grew 21% year over year. Company forecasts 2026 subscription sales of at least $15.5 billion, ranked number one for building and managing AI agents in 2025. And you can hit pause and read that if you want. And Salesforce, I have no delta exposure to Salesforce. Has a CRM moat, a data moat, and is moving aggressively with Agentforce. 8,000 plus customers as of early 2026 in the AELA pricing model. Strong position, but execution risk, HubSpot. A standout story of early 2026, posting 20% year-over-year growth while aggressively pivoting to an agentic platform. Its customer agent reportedly resolves 50% of support tickets without human intervention. So here I got to fault Opus a little bit. They're using it internally, but how do you use it to protect yourself from seat compression? I don't know that this here makes the case. Workday has deep embedded workflows in HR and finance, two domains ripe for agent automation, but its execution has been shakier. CEO stepped down. Data moat in payroll, benefits, and workforce planning is formidable, but the company needs to move fast on aging capabilities. Again, they're saying strong position, but with execution risk. SAP is the next one. Niche winners. This is where it gets really exciting. Palantir, Datadog, and Cloudflare. Now, I did this after I had decided that Datadog was going to be the profile company for the week. Because the more you have AI agents, the more observability you need. So this was sort of nice to see it down there. Datadog and Cloudflare. CrowdStrike and Palo Alto. The most at risk. Companies whose value proposition was primarily a user interface layer on top of commodity workflows. Think horizontal project management tools, basic CRM, simple help desk software. They show up with Monday.com. HubSpot were cited examples of this vulnerability. So in the niche winners, I do have delta exposure to Palantir, to Datadog, to Cloudflare, to CrowdStrike, to Palo Alto. I have all of these. I have none of these, although I do use HubSpot for email marketing. I have no exposure to any of these. And up here, I do have exposure to Microsoft and to ServiceNow. Okay, let's have a look at S&P. We are down at 21.79 times forward operating earnings at 313.73. Closing SPX 68.36, down from 22.1, with a lot more volatility, a lot more profitable to sell some puts. All-time high 697.16. We're sitting as of Friday closing 2.26% below that. IWM is 2.63% below its all-time high. IJR only 0.78. We are halfway to a correction on triple Qs, down 5.17%, down 10% is called a correction, down 20% is called a bear market. We are halfway to a correction on triple Q. We have 53 companies, at least I'm being told. We have 53 companies reporting next week. We'll have a look at the earnings calendar next. IV last 16.8. You could see a small spike up here, almost to 27%. During the course of the week. And I don't know that this turns around. I think you can expect choppy markets for the rest of this year. I know that sounds unsatisfying. This is not an investor's market anymore. It was an investor's market for a long period of time, but when you see something like this, that is a trader's market. And that is a beautiful place for volatility if you know how to play that game. Why do I say that? Well, look at what's happened over the last 2 weeks. AI application destroying this, AI application destroying that, calling the question, what have we done? SaaS companies, insurance companies, wealth management, trucking, logistics. And this is coming from a karaoke company. Says, hey, we got an AI agent that can handle all of this. And companies in that space, 15% down. This is going to be like 1999, where a .com would IPO, and the companies, the bricks and mortar equivalent of it, would take a step down. And there was a lack of understanding that, no, don't you seem to understand that the bricks and mortar company can use the internet just as much as these companies can use the internet. Walmart is not gone, it just has a website. Costco is not gone, it just has a website. Now you may say there are fewer malls, but the decline in malls was going on since the middle of the 1980s anyways. I don't know that I would blame the .com and the existence of the internet for the decline in malls. They were happening anyways. But all of the hits that happened, Walmart's a much bigger company today than it was in 1999, and everything is going away. Retail's going away. Bricks and mortar is being replaced with clicks. Bricks are gone, clicks are in. And it was this division without realizing that what if the bricks start using the clicks, right? And we have all of these companies being destroyed. It's like, well, hang on a second. What if they start using the AI themselves? Then they're not gone. They still maintain that lead. So I do expect this week coming up, look for more AI applications. Look for more bombs blowing up in your portfolio here and there. But there is one sector which I think right now is fairly immune from any AI applications, metals and mining. And it is going to be, I think, the hottest sector over the next 5 years is metals and mining. Let's have a look at our earnings calendar. Okay, and keep in mind I'm simply just reporting this as it is presented. Monday, Constellation Energy. Monday's a holiday. I don't know if that's entirely true, but it's not unheard of. There it is. Let's get into Tuesday. And pre-market is all the way up to Vulcan Materials. You have anything interesting? DTE Energy, Genuine Parts, Medtronic. After the close, Devon Energy, First Energy Core, Palo Alto. I've got exposure to that. And I might do an earnings play on Cadence. On Wednesday, before the market opens, we end right here. Anything interesting? Garmin, Analog Devices, Moody's, and then after the close, what do we have? That's in CF Industries. That's kind of interesting. Carvana, DoorDash. Not that I'm in those, but they are interesting. Invitation Homes. That is a REIT. Occidental, if you're in OXY. Molson Coors. Going into Thursday morning. There's a big guy right there, Walmart. Southern Company of Deere. Deere's a big one as well. Pool Corp. It's in discretionary. And we're still before the bell. After the bell, Akamai. Anything else interesting? Newmont. There's your big gold miner down there. And going into Friday, I don't think we have much. And that would be it for the week. This is just S&P 500. Anything outside the S&P, there's a lot of interesting companies outside the S&P. There'll be some of those reporting this week as well. I really just focus, when I do the earnings for the week, I focus on the S&P because that's really what gets the press coverage and really what moves the market. All right, our spotlight company of the week is Datadog. I was going to do this last week, but I decided it was more important to look at, the carnage in the SaaS space. And it was a toss-up between Datadog and Dynatrace. And I really went back and forth between the two. I prefer Dynatrace's approach to this. And they are better on some metrics than Datadog, but Datadog is better on other metrics. In the end, I simply took the one with the higher growth rate. That was higher revenue growth rate. That was Datadog, because if we're using Rule of 40 and Rule of X says overweight the revenue growth. That matters more. Datadog was the winner on that one, so I chose that. They're in the observability space. And I have a nice presentation done with the help of Nano Banana that will tell you exactly what the observability space is. Let's just have a look at some high-level numbers right now. Their competitors, Dynatrace and New Relic, Splunk and AppDynamics, they're within Cisco, plus Amazon, Microsoft, and Google, but these are cloud-specific, whereas Dynatrace is cloud-agnostic. So most organizations, large organizations, have multi-cloud deployment. That would be a Datadog or a Dynatrace. If you have single cloud deployment, a lot of this stuff is included in with Amazon, Microsoft, or Google. Last 52 weeks, if you draw a line across here, 52 weeks, you can say, well, year over year, you got nothing. But they did hit a low of 81.63 and then had a nice run all the way up to 201.69, 250% run. Well within the year. You can see earnings over here. Market really liked it, and you had earnings over here for the past week. Market really liked it, but just the narrative in the market is that all this is going to disappear. The fact is, the more AI agents you have out there, the more observability you actually need, so that their addressable market is set to grow. Let's look at some numbers. Market cap $43 billion. They are the largest by revenue, at least that you can tell, because Amazon, Microsoft, Google, and being that these are within Cisco, really don't tell you what those numbers are. If you're looking for pure play tickers, largest by revenue. Revenue year over year up 30%. It's a growth rate. Gross profit up 28.8%. Operating income up 28.4%. 81% gross margin. All of this is non-GAAP here. 81% gross margin. Operating margin 24%. On their balance sheet, cash and cash equivalents, $4.5 billion. Operating cash flow from the quarter. The quarter they just reported, $327 million. Up 30% quarter over quarter. That's not year over year. That's quarter over quarter. So revenues, $953 million for the quarter that was just reported. That's that nice big green bar in here, up 29% year over year, as we pointed out here. EPS, non-GAAP EPS, 59 cents, up 20% year over year. Customers, 32,700. Last year, same quarter, 30,000 customers, so about a 9% growth in customers. 4,310 of them have an annual revenue run rate greater than 100,000 versus 3,610 1 year ago. So that is a growth of 700 from the 3,610, almost 20% growth in getting them in getting your customer count over 100,000 on the run rate. 603 are over a million versus 462 last year. That is a 30% increase. They have a lot of different products. So if you go to their website, you see they have a free version. Then they have a fairly inexpensive monthly subscription, really inexpensive. So if you have a company with 2 or 3 developers building something, it's not a very expensive cost per month. That is their land part of the strategy. Let's just land and expand. So to judge the effectiveness of that strategy, each quarter, year over year, we want to see what percentage of their customers are using 2 or more, 4 or more, 8 or more. 84% of their customers are using 2 or more services, up from 83%. 55% are using 4 or more of their services, up from 55%. 33% are using 6 or more, up from 26%. And this is the big one, 8 or more services, 18%, up from 12%. Land and expand. Looks like it's working. Acquisition. So they acquire adjacent services, horizontal acquisition. Trailing 12-month net revenue retention rate, 120%. That may seem like a weird number. What does that mean? It means if you take only their existing customers they had over the last 12 months, and you look at how much revenue they generated versus the previous 12 months, that is the net revenue retention rate just from your existing customers. In other words, they grew 20% without adding a single customer. Now that 20% is going to be an important number. Datadog has we wouldn't call it a reputation, but a tendency to underestimate their guidance, to guide lower. And if you look at their net revenue retention rate, you find that they simply just guide by that. And that's not counting any new customers. Remember, the revenue growth is 29.2%. If we look at their 2026 guidance is simply, if you took 2025 sales and you multiplied it by 1.2, you get the midpoint to the 2026 range. They're simply just using the net revenue retention rate for the forward guidance and not guiding on any new customer acquisition. So that's fairly conservative. Rule of 40, let's see what they have. Revenue growth rate, 29.2, free cash flow margin, 30.5, 59.7, well over 40, which means they should be able to justify a forward multiple on a PE, adjusted PE basis of around that number. Let's see what they have. Forward guidance on their EPS they give for 2026 is 212. Remember, they're just saying 20%. That would give them almost a fair value at what I consider a baseline forecast for growth over the next year, 59.06. Forward price to sales, 10.56. That's fairly low. And that's where they're guiding their revenue, 4.08 billion. I seem to think that they could probably deliver 4.3 to 4.4 billion based on their history of always guiding lower. They like to please the street. They like this stuff going on. Same over here, although the market gave it up fairly quickly. Let's have a look at what observability actually is. Okay, let's wrap our heads around the idea of observability. And it really, when we're done, you'll see it comes right down to that word. Oh, you're actually just observing. That's exactly what we're doing. But observing for what? Let's start with the traditional method, application performance monitoring. Is you have systems running and something goes wrong and you get a notification that the payment system has failed. And you go in and you fix the payment system. You find the problem, you discuss with people, you eventually fix the payment system, and off you go. But the shift to cloud native, a single user request will now touch dozens of different services. So your user request goes in, touches a whole bunch of different services, and you get a notice that, oh, your payment system is down. What is it? Which one was it? So for all of these, you're going to have to collect a lot of data, called telemetry. Logs, this is time-stamped records of discrete events, different metrics to see CPU usage, things like that. And then different traces. So let's say that you have a metric that says, you triggered a problem. You would then go to a particular application and you would look at the logs and you say, well, okay, this is the timestamp, and then you would trace it through all the other applications that it might have used to say, aha, here it is. We're going to see later on that, well, that's interesting. Well, what if you can get AI to say, aha, that's where it is? And that is, we're going to see that is what they're doing. Some converging trends that make observability essential. Cloud acceleration. And not just cloud acceleration, but multi-cloud acceleration. Gartner predicts 90% hybrid cloud adoption by 2027, that most organizations will be multi-cloud. Distributed workloads and multi-cloud strategies. So even though AWS, Azure, they have their own observability platforms, they are cloud specific. So if you have multi-cloud adoption, you're going to need to step outside each of the cloud-specific observability platforms. Telemetry data explosion. Virtual machine-based deployments have low data volumes, but cloud-native deployments 10 to 100 times more monitoring data. And AI agentic complexity. We'll spend some time on this one because that's really where observability is probably going to survive, is in this space. All of that makes observability essential. Okay, we've seen this a little earlier, the three pillars of observability: metrics, logs, and traces. Let's move to something called open telemetry. And to understand this, let's look at what things were like before. You had a company that wanted to use, let's say, Datadog for its observability platform. It had to send telemetry from its applications to Datadog, but that resulted in a proprietary system that if the company said, well, we want to go to another competitor, that was a difficult process. You had significant lock-in. Companies don't really want lock-in, want to find a way around. Open telemetry does that. So here's the company producing a flow of telemetry. And they can simply just say, well, send it to Datadog or send it to Dynatrace or send it to Grafana, because it's open. It's an open platform in that sense. It's not proprietary to any single one. You can direct it to any of the competitors, so switching becomes easier. So from a customer perspective, a lot better. And for the observability platforms that don't adopt it, you're simply going to lose customers. So you're going to have to embrace it and adopt it. What it does is it just shifts the competitive battleground from data collection to analytics, visualization, and the intelligence layer. Data collection becomes commoditized. Let's look at how observability platforms are integrating AI into their product. Anomaly detection. Oops, that's a terrible color here. Let's see if we can find something better. Anomaly detection. So we're still producing metrics, logs, and traces, except the AI is now monitoring, saying, something looks off here. Root cause analysis, then going through the logs and the traces to say, it's over here, and then even automated remediation. This is the hope, but this is where AI is useful for the vendor. Let's have a look at incorporating AI agents from the customer perspective. Traditional software, very deterministic. Let's get our color changed over here, very deterministic. Inputs and outputs, so you can easily spot failure. But with AI systems, they're non-deterministic, they're probabilistic. They produce anomalies all the time. So your responses can be different and context dependent. So failure could be partial. It's not binary. Here it's pretty obvious. It either executed or it didn't. I remember with my IT team, whenever there was an issue or a problem, it's like, well, it's not happening now. It only happens every now and then, so let's not worry about it. And I would say, no. Code does not make up its mind. Now, this was before AI. It doesn't make up its mind. It either works or it doesn't. And if it only fails 3 out of 20 times, still, it doesn't work. There's an issue. It doesn't just decide, you know what, I don't feel like it today. But with AI systems, you do have that. It does make up its mind. So how do you begin to determine whether or not you have a failure in place? So we do have challenges, and it is specifically these challenges that make observability more of a necessity if a customer is using AI agents. So let's look at that problem at a higher level. Agentic AI, the promise and the pause. This is not writing. There we go, the promise and the pause. Lack of confidence, governance, and trust. Pilot to production threshold. Enterprises are investing, but pausing due to inability to monitor and govern autonomous systems. Here's your challenge. You have nonlinear workflows that are probabilistic, non-deterministic behavior. The same workflow might succeed or fail on subsequent runs. Traceability is critical. Enterprises need to know what the agent did, what data informed the decision, and why it chose that action. So observability is the gating factor. Platforms providing traceability and governance gain significant competitive advantage in enterprise sales. So we want to, in looking at Datadog or Dynatrace, ask the question, what work are you doing with AI agents from your customer's perspective? How are you handling the observability of this? I think this gives you the strategic imperative very nicely. The stakes are substantial. Capturing this layer early may define the next generation of the observability market. Expanded market. Agentic AI is additive to existing demand. Every AI deployment requires monitoring, creating new telemetry volumes, new use cases, new budget lines. Deep analytical advantage. Monitoring non-deterministic systems requires sophisticated causal analysis, not just threshold alerts. mission critical embedding. Platforms routinely accessed by agents via MCP, that's Model Context Protocol, become deeply integrated infrastructure. This embedded position creates powerful, difficult to displace competitive moats. That is what we're looking for. Trust is fundamental observability problem. Vendors that effectively enable monitoring, auditing, and understanding will not just benefit from AI growth, they will enable it. Let's look at some structural characteristics of the observability market. It is a fragmented market, but that does present opportunities for companies like Datadog and Dynatrace. They do grow through acquisition, so there is a lot of acquisition opportunities. The growth profile, cloud adoption, system complexity, telemetry volume, AI workloads, regulatory mandates. I don't know how much I'd put on that. It is fairly resistant to macro downturns, justifies premium valuations. Customer dynamics, high net revenue retention. We saw this with Datadog at 120%. Observability is not an option. If you have a system that requires 100% uptime and that downtime is very expensive, especially when you're dealing with a whole bunch of different systems that are interacting, that one request might touch 12, 13, 14 different systems. If you go down, tracing through that without telemetry is going to be very, very difficult. So that observability is almost just table stakes. Strong land and expand motion. High stickiness, product market fix. This is nice. Durable, resilient demand, strong expansion dynamics support long-term value creation and premium market valuations. So as I said earlier, I was torn between Datadog and Dynatrace. Datadog has a lot of platform breadth, a lot of different applications, whereas Dynatrace has got a lot more depth over breadth and far more enterprise customers. Their average customer spend is higher than Datadog's, but as far as growth rates, we'll see shortly, Datadog has a much higher growth rate. As of January 12, 2026, for Datadog, there were two analyst reports out. Goldman Sachs target price 113 with a sell. Morgan Stanley 180 with an overweight. Same date. Diametrically opposed viewpoints on this. Goldman Sachs says cost competition. Datadog will have to lower prices, which will lower revenue. Morgan Stanley, AI and agentic AI will create the need for more observability. The evolution of observability pricing models, host-based pricing, fixed fee per server, virtual machine or container. Moving to consumption-based models, this is the trend. Hybrid and subscription models is sort of the best guess of where we're going to end up. Pricing here is based on actual usage, data ingestion, or platform consumption. This addresses the issue earlier with if AI can reduce, and AI agents can reduce seat count, how do you preserve your revenue as a company that perhaps had a per seat or per server fee? Is you would then have to say, well, if your agent is going to do the work of 10 people, it's going to use 10 times the services. We should have some kind of service-based pricing. Lower initial revenue, but higher lifetime value. And let's have a look at typical cost structures. The three big cost categories you're going to find on either Dynatrace or Datadog. Research and development typically runs 20 to 30% of revenue. Sales and marketing typically 25 to 35% of revenue, and general and administrative 6 to 10. This is where you get some leverage, because as you grow, that becomes a smaller part of revenue. To compare the two, Datadog has higher revenue growth rate versus Dynatrace, higher net revenue retention rate, larger absolute revenues, and does have a higher valuation multiple. If we think of rule of 40, you're adding the revenue growth plus the free cash flow growth. If you think of rule of X, you're weighting revenue growth higher. Maybe it's 1.33 and 0.67. Maybe it's just a 2 and a 1. But you are giving more weight to revenue, which is why I chose Datadog, because it does have the higher revenue growth rate. Dynatrace, higher gross margins, like 600 basis points higher, somewhere around 87% versus Dynatrace's 80 to 81%. Higher non-GAAP operating margins, larger new customer size, more enterprise-weighted customers, not as wide a product offering as Datadog has, but it does have a number of services that it offers, but in each one it goes much deeper. Some key metrics for evaluating observability businesses: net revenue retention. We already saw that with Datadog, 120, and how we read that is without adding a single customer, assuming you don't lose a single customer, revenues grew 20%, and that's, if we want to forecast forward, it is a conservative forecast moving forward. Gross revenue retention rate. This is slightly different than the net revenue retention rate. This includes all customers. Free cash flow margin, that is part of Rule of 40. And remaining performance obligations. This one's a tough one to get. Sometimes you'll get it. Datadog gives it to you, but you do have to dig around for it. I could not find it for Dynatrace. I looked in their 10K, I looked in their 10Qs, their most recent report. I looked for every variation of remaining performance obligation. I looked for remaining, I looked for performance, I looked for obligation, I looked for RPO. I could not find it. So sometimes they report it to you, sometimes they don't. I chose Datadog again because it had the higher revenue growth rate, almost double what Dynatrace has, but Dynatrace does have the higher gross margins. And if you follow rule of X and you overweight growth, you almost have to take Datadog. Its guidance is always low. It has a reputation for low guidance. So rule of 40 scores a 59. The adjusted PE to align with rule of 40 is a 59 times. The higher you are above 40, the higher the forward multiple that you can justify. And then you assess the companies based on how are you not only incorporating AI into what you do, so you can spot anomalies, you can trace those anomalies and fix those anomalies without any intervention. But what are you doing to support the observability of AI agents? And both of them, Dynatrace and Datadog, are moving in that direction. The market, on the other hand, is looking at them saying, I don't know. Because Datadog, both Datadog and Dynatrace on earnings pop, and then gave it right back. Same with Dynatrace. They were low 30s, popped all the way to 37, gave it all the way back. Datadog was low 120s, mid 120s, all the way to the high 130s, gave it all back. So I don't know if that is a backdrop of the SaaS sell everything without thinking. Let's just shoot first and ask questions later. Or whether or not there is a belief in the market that, well, they're not actually gonna be able to capture the AI side fast enough to counter the reduction in revenues. I don't quite believe that, because observability is the gating factor. It's not the catch-up, it's the gating factor. When I say the catch-up, I don't mean mustard and ketchup. I mean, it's not going to catch up to where its clients are. Its clients will not move faster than what can be observed. So because it's the gating factor, the better and the faster that they can implement observability for these probabilistic systems, the faster AI agents will be deployed within organizations. Because no manager is going to say, oh yeah, go ahead. Let's not worry what it writes and what it says. They're not going to let any AI agent probabilistically touch their database or touch any of their data until observability is in place. It is the gating factor. So I think the sell-off and the negativity in them is unwarranted, because you're not going to have a bunch of AI systems in place until you can actually observe them. Observability is first. Everything else follows. I do have Delta exposure to Datadog, and I do have Delta exposure to Dynatrace. I have them both. And that wraps up the company for this week.